Sometimes, the best ideas come from others. More often than not, famous researchers are inspired by studies before them. Even great inventions have their inspirations. This is exemplified by a famous quote from Oscar Wilde, which states that imitation is the sincerest form of flattery. In investing, cloning is also rampant. Well, as long as you get profit from it, why not, right? This video will show you where to properly invest in the market, just like those of super investors in 2022. Be with me as we become clones of those investors. Make sure to like this video and subscribe to the channel before we proceed. We can get this information because a government agency, the Securities and Exchange Commission or SEC, requires investors to reveal their portfolios every 3 months as they enforce a law that promotes the prohibition of market manipulation. I'm going to give you the top 5 most bought stocks by our prominent investors. First on our list is Amazon with a ticker symbol of AMZN, which is among the world's largest companies with a market cap of $1.6 trillion. In 2021, the company had a total revenue of $470 billion, which was nearly a 22% rise from the year 2020 when online shopping boosted its potential because, the corona. Yep, that was when you, me, and everybody stayed in their homes with their phones and ordered everything and anything they could see on the internet. Social media played a great role in advertising. Facebook, TikTok, Instagram, Twitter, and the like. A no-heat hair curling item? Add to cart. An air fryer? Add to cart. With just a simple click, your order is already processed. Amazon was among the ones who benefited from this predicament. Online sales brought in more than 50% of the company's revenue. Third-party seller services accounted for over 20% of revenue. AWS, or the highly profitable cloud computing platform of the company, rendered about 15% of revenue, while subscription services, advertising, and physical stores accounted for the remaining revenue. The company is currently trading at a PE ratio of approximately 70 times. Though it may seem like a very high number, Amazon had its PE ratio at the beginning of 2018 at nearly 250 times. Amazon is growing very fast, and it is expected to grow by over $132 per share by 2025. But even with this growth, its stock price has remained the same since the summer of 2020, which is at $3,200 per share. Second on our list is something that's commonly plastered on the surfaces of your credit and debit cards. Do you have a guess? Well, if you guessed the ticker symbol of MA, MasterCard, which is one of the world's most recognizable brands, then you're right. The company revenue comes from a fee paid by their customers. Now, don't get me wrong, it doesn't come from everyday consumers like us, but rather from financial institutions which pay a fee to issue cards to their customers, such as banks. MasterCard has a market cap of $340 billion and a PE ratio of almost 42 times. Unlike Amazon, which requires warehouses and stores to stock their products and other physical assets, this company as a payment network does not require one, which enables them to produce a lot of cash in the process. In fact, by 2021, it produced $9.1 billion of free cash flow with a revenue of 48%. Something which is valued very highly by investors is the ability of a company to produce tons of cash, in which MasterCard specializes at. With its positive cash flow, there's no doubt that it can be considered a cash flow royalty. I'm pretty sure that you're a patron of the two from our list, and it's truly appreciated if you also become a patron of this channel by liking and subscribing. Now, moving on. Next on our list is probably the most famous social media platform. Facebook, or its rebranded name, Meta Platforms, with a ticker symbol of FB, is the second most controversial stock on this list. Half of the group of people think that Meta is a sure buy while the other think otherwise. This company is commonly known for its family of apps with Facebook, Instagram, Messenger, and WhatsApp. They gain their revenue from selling advertisements to marketers to an audience of 3 billion monthly active users. Its ads enable marketers to reach people of varying ages, gender, location, and interests, as these types of ads are very valuable for companies who are trying to sell their products. I think you know someone who buys products that they see being advertised on Facebook or its sister apps. Although Meta Platforms have been showing proficiency in the market since its establishment, it took a fall in September 2021 as the Meta stock was down by over 40% from its usual high, which became a concern for investors as the company finally found its match in another social media platform. and I'm sure a lot of you are very familiar with it. TikTok, which has been taking away customers, making investors worry when an era of short video may overpower that of what Facebook generally offers. Aside from that, Metaverse, which is a segment of the company that includes augmented and virtual reality consumer hardware and software, lost over $10.2 billion last year in 2021, which caused the stock price to go down from a high of $380 million in September 2021 to less than $200 million per share in March of this year, which then resulted in a decrease in the PE ratio, which was 35 times in 2017 to an all-time low of 15.7 times, which causes a concern for investors. Fourth on our list, which is among our super investors' favorites, is Visa. This is just like MasterCard since it requires no physical assets. It draws in enormous amounts of cash. Both Visa and MasterCard have what is referred to as a duopoly in their industry, where there are two big players in control and all the other small companies are fighting for that remaining small percentage in the market. Do you know any other soft drink brands? Well, only a few, right? Because these two hold the market in their palms, which is the same with Visa and MasterCard, with a combined percentage of control of the two in the United States alone at 90% of the market, with Visa grasping about 60% and MasterCard with its 30% hold. And the remaining 10% are for the other small businesses in the same field. Visa holds so much dominance in the market that its market cap is around $500 billion, which reflects its higher revenues than MasterCard. Aside from that, the company also has a huge market share. Its stock price is currently around $220 per share from a high of $250 in the summer of 2021. Visa had a revenue of $25.5 billion and generated free cash flow of around $14.5 billion, which is an overwhelmingly free cash flow margin of 56.9%, making it significantly higher than MasterCard. Visa has probably the highest free cash flow margin in the business because its business model does not require huge costs to operate the business, which then allows it to generate a lot of money, and I mean a lot of money. Are you also interested in investing where these super investors are placing their cash in? Well, don't forget to hit the like and subscribe button before we continue to our last stock in today's video. The final one on our list has one of the most polarizing stocks in the market, which divides the crowd into two. One group sees it as a golden buying opportunity while the other perceives that the stock is having a significant risk of going to zero, and that stock is none other than Alibaba. This company is the world's largest e-commerce company and has been described as the Chinese Amazon. Billionaire Charlie Munger had a very large bet on Alibaba. It was one of the very first stocks that he bought in years. As the largest country in Asia, China has over 1.4 billion citizens, which means that as the country's economy grows, businesses such as Alibaba will also prosper, which is evident in the company's growing revenue, which hit 41% last year in 2021. Another reason why investors love Alibaba is because of its value. It currently trades at a PE ratio of just 15 times and has a market cap of $290 billion. While we have willing investors on this site, some wouldn't invest in this stock, and would-be sellers state that the stock is cheap for a reason and the biggest risk is the Chinese government. Alibaba's stock reached a high of $310 per share in October 2020, but this has been continuously declining and has reached a low of $100 per share. This might be caused by the limits the government has imposed on the company in what the government refers to as its common prosperity, which even included the banning of online tutoring companies for making a profit. The shares of Chinese tutoring companies fell from 98% to 70%, which essentially wiped out investors from those companies. This sent investors running to the hill, which also is why Alibaba's shares have been continuously plummeting. The market is indeed unstable and volatile. No matter where you or any super investor place their money, there are bound to be risks that should be taken into consideration. At the end of the day, it's up to you if you want to proceed with their paved path or build a track of your own. Once again, don't forget to hit the like and subscribe button before you go. See you!